Hey everyone, welcome back to CivilsCore. Aditya here. Today we are covering a topic that is absolutely perfect for UPSC Prelims, Mains GS Paper 3 and even the essay paper. It is about the RBI's current monetary policy stance and why the central bank is doing something that looks like it is doing nothing. It is called the strategic wait and watch. And by the end of this video, you will understand exactly why this is one of the smartest and most difficult decisions a central bank can make. Let us get into it, slide by slide. Let us start with the core tension the RBI is dealing with right now. Picture a weighing scale. On one side, you have inflation sitting at 5.1%, which has gone up from 4.6% in April. On the other side, you have economic growth, which has slowed down to 6.6% from 6.9% earlier. Now remember the RBI's inflation target. It is 4% with a band of plus or minus 2%. So 5.1% is above the target but still within the band. It is uncomfortable but not a crisis yet. The central bank's mandate is to tame the fire without grinding the gears to a halt. In simple terms, bring inflation down without killing economic growth. And right now, both are moving in the wrong direction at the same time. Inflation is going up, growth is coming down. That is the dilemma. So what did the RBI do? It kept the repo rate unchanged at 5.25% and shifted its policy stance to neutral. Now, what does neutral mean? It means the RBI is neither actively trying to boost growth by pumping money into the economy, which is called accommodative stance, nor is it aggressively trying to pull money out to fight inflation, which is called withdrawal of accommodation. Neutral means I am not pushing the accelerator and I am not pressing the brakes. I am watching the road carefully and keeping my options open. This preserves maximum flexibility to react quickly if something changes suddenly, whether that is a global shock, a monsoon failure, or a sudden spike in oil prices. Neutral is not inaction, it is strategic patience. Now, let us understand what is driving inflation up to 5.1%. Two main factors. The first is a fuel shock. In mid-May, fuel prices were hiked. When fuel prices go up, everything connected to fuel goes up too. Input costs for factories rise, transport costs rise, logistics costs rise. This pushes up the price of almost every product in the economy. The second factor is monsoon uncertainty. India's agriculture still depends heavily on the monsoon. If rainfall is erratic or poorly distributed across regions, crop yields fall. And when crop yields fall, food prices spike. Food inflation in India can be extremely volatile, and it directly hits the common person's household budget. So the RBI is watching the monsoon pattern very carefully because it could make the inflation picture significantly worse in the coming months. Now, on the other side of the scale, why is growth slowing down to 6.6%? The answer is high input costs. And here is the chain reaction. Step 1. Fuel prices and raw material costs go up. This squeezes corporate profit margins. Companies are spending more to produce the same output and earning less from selling it. Step 2. When profit margins are squeezed, companies postpone or cancel their capital expenditure plans. They stop building new factories, they stop buying new equipment. Private investment slows down. Step 3. When private investment slows, jobs are not created at the same pace. Rural incomes stagnate, consumer demand in the rural economy gets dampened, and dampened demand feeds back into slower GDP growth. So inflation is not just a price problem, it is also a growth killer when it gets embedded through high input costs. That is the double squeeze the economy is facing right now. Now let us understand why the RBI cannot simply pick one side and go all in. Think of a seesaw with three positions. If the RBI hikes rates aggressively to kill inflation, borrowing becomes more expensive. Companies borrow less, investment falls further. Consumers borrow less for homes and cars. Domestic growth gets crushed. The inflation fire goes out, but the engine of the economy stops running too. If the RBI cuts rates to boost growth, cheap money floods the system. Spending increases, but inflation, which is already at 5.1%, gets more fuel. Prices run away. The fire becomes an inferno. So neither a rate hike nor a rate cut works cleanly right now. The third position on the seesaw is wait and watch. Hold at 5.2.5%. Maintain neutral stance. Watch how inflation and growth evolve over the next few months before making the next move. That is exactly where the RBI is sitting right now. But the RBI is not just dealing with domestic problems. There is a very serious external threat too. It is called capital flight. Here is how it works. When the US Federal Reserve keeps interest rates high, American government bonds offer safe and attractive returns. Foreign portfolio investors who park money in Indian stocks and bonds for returns start thinking, why should I take the risk of investing in an emerging market like India when I can get higher and safer yields by simply putting my money in the United States? So they pull their money out of India and send it to the US. Dollars flow out of India. This puts pressure on the rupee and reduces the pool of foreign capital available for Indian markets. The US Federal Reserve's decisions directly impact India's capital flows, even though it has nothing to do with India's domestic monetary policy. That is the global interconnection the RBI has to factor in. The capital flight threat connects directly to the rupee. As dollars flow out and India's import bill stays high, the rupee comes under sustained pressure and loses value against the dollar. Now there is a psychologically critical threshold that everyone in the financial world is watching. That threshold is rupees 100 to $1. If the rupee breaks past this level, it sends a very bad signal to global investors about India's macroeconomic stability. It could trigger even more capital outflow, which weakens the rupee further, which triggers more outflow. It becomes a self-reinforcing cycle downward. So the RBI is also walking a tightrope on the currency front. Keeping interest rates from falling too much helps support the rupee by keeping the yield differential with the US attractive enough for foreign investors to stay. Now, here is where the rupee and inflation connect in a very dangerous loop. India imports 80% of its crude oil. 80%. That is an enormous dependence on imported energy. When the rupee weakens, the cost of importing crude oil automatically goes up because oil is priced in dollars. So a weak rupee means you need to spend more rupees to buy the same barrel of oil. This pushes energy prices up domestically. Higher energy prices raise logistics costs. Higher logistics costs raise the price of everything that gets transported. And general inflation worsens further. So the loop is this. Rupee weakens, energy imports cost more, logistics spike, general inflation rises, which then puts more pressure on the RBI to respond. A depreciating currency directly imports global inflation into the domestic economy. And because India cannot produce most of its own oil, this is a structural vulnerability, not a temporary one. On top of all these domestic challenges, the RBI also has to factor in two major geopolitical wildcards that could change everything very quickly. The first is the West Asia conflict. Any escalation in the Middle East threatens global energy security and disrupts Red Sea maritime trade routes. If oil supply gets disrupted, crude prices could spike dramatically, and India, importing 80% of its oil, would be hit very hard. The second wildcard is supply chain fractures. Global supply chains are still not fully recovered from disruptions of recent years. Any new fracture, whether from geopolitical tensions, climate events, or trade restrictions, can suddenly spike input costs in unpredictable ways. Because both of these wildcards are unpredictable in their duration and intensity, the RBI cannot give clear forward guidance on where rates are going. This uncertainty itself is one reason why holding steady at neutral makes strategic sense. Now here is a very important concept that often comes in UPSC mains. There is a limit to what monetary policy can do on its own. If the RBI raises rates to fight inflation, it damages the already slowing economy. If it cuts rates to support growth, inflation gets worse. The RBI is caught in a bind where both its available levers have painful side effects in the current situation. This is the breaking point of monetary policy. When monetary policy is constrained, structural coordination becomes essential. This means the government of India and its fiscal policy must step in to do what the RBI cannot do alone. The government needs to use its spending, taxation, and structural reform tools to defend the rupee and support the economy in ways that do not create more inflation. Monetary policy and fiscal policy must work together, not in isolation. So what does this coordinated approach actually look like in practice? There are tools on both sides. On the fiscal policy side, the government can offer capital gains exemptions to foreign investors on government bonds. This makes Indian bonds more attractive to foreign investors and brings dollars in. The government can also remove withholding tax, which is the TDS deducted on interest income. Removing this increases the effective yield for foreign investors and makes India's bond market more competitive globally. On the monetary policy side, the RBI can offer concessional foreign exchange swaps. This lowers the cost of hedging currency risk for companies that want to borrow from abroad, which encourages more foreign borrowing and dollar inflows. The RBI can also expand the fully accessible route known as FAR, which opens more government securities to unrestricted foreign investment without any limits. More foreign investors can come in and buy Indian government bonds, which again brings dollars in and supports the rupee. Together, these fiscal and monetary tools act as a coordinated defense arsenal to attract and retain foreign capital while managing domestic pressures simultaneously. There is one more dimension to the wait and watch stance that is often missed but is extremely important. It is about credibility. By refusing to cut interest rates despite slowing growth, the RBI is sending a very powerful signal to global and domestic investors. The signal is this: the RBI will not sacrifice its long-term inflation target of 4% just to make growth numbers look better in the short term. It will not take the easy political path of cheap money. This builds credibility, and credibility is arguably a central bank's most valuable asset. When investors trust that the RBI means what it says about price stability, they are more willing to invest in India for the long term. They know that India will not let inflation run out of control. This long-term trust is what anchors the rupee, keeps bond yields stable, and attracts serious investment. A central bank that cuts rates under political pressure destroys credibility. A central bank that holds firm builds it. The wait and watch cannot go on forever. While the RBI buys time, India needs to address two deep structural cracks that make it perpetually vulnerable to these dilemmas. Crack 1 is energy dependence. India's 80% crude oil import dependency means every global oil price shock or rupee depreciation immediately worsens our inflation and current account deficit. The long-term fix is to accelerate the transition to renewable energy and electric mobility so that over time, India's dependence on imported oil falls dramatically. Track 2 is fickle capital. India's financial markets are heavily dependent on foreign portfolio investment flows, which are extremely sensitive to global sentiment and US interest rates. When global risk appetite changes, these flows reverse suddenly and the rupee takes a hit. The long-term fix is to deepen the domestic bond market so that Indian companies and the government can raise money domestically, and to attract more stable FDI into manufacturing, which does not leave the country at the first sign of global uncertainty. And this is where we close. The RBI's 5.25% neutral stance is fundamentally an exercise in strategic patience. The central bank is watching three things very carefully before it makes its next move. First, how the monsoon distributes itself spatially and temporally across India. If it is good and widespread, food inflation comes down and the RBI gets room to cut rates later. If it is erratic or poor, food inflation spikes and the RBI may have to hold or even hike. Second, where global crude oil prices are heading. If geopolitical tensions ease and oil prices fall, India's import bill lightens, the rupee gets support, and inflation pressures reduce. Third, whether capital flight from emerging markets to Western havens persists. If the US Federal Reserve starts cutting rates, the yield differential narrows and money starts flowing back to emerging markets like India. The moment the skies begin to clear on these three fronts, the RBI will have the room it needs to start easing rates and supporting growth more actively. Until then, holding steady at 5.25% and staying neutral is not indecision. It is the only responsible decision available. That is it for today. The RBI's strategic wait and watch fully decoded. This topic is perfect for GS Paper 3, the essay paper and current affairs. Keep revising, stay consistent, and I will see you in the next one. All the best, everyone.